YouTubers, Mike Martin's here, Mike Martin's channel. Again with another housing discussion from Australia. What is happening down under? I need people, boots on the ground there. I need people that I could call in, or people that could call into the show, so we could get some boots on the ground, some confirmation on what's happening from street to street, borough to borough, province to province. If you're living in New South Wales, please contact me via email. You can find my contact information somewhere here on this page or my Facebook page. You will see a link to my Facebook page and get you on the show to give us an insight on what's actually happening there. So this is an interesting article from Your Mortgage, and it's obviously one of those financial magazines that they mail to you and to give you better insight on which stocks to trade, which stocks to buy, which stocks to stay away from, bonds and gold and whatever, right? So I want to read this to you guys because it is posted from a few hours ago. So what could trigger a housing market crash in Australia? It is without doubt. It's without a doubt, that the market is sprawling down as prices continue to decline, particularly in Sydney and Melbourne. While the expectation of the market crash is unlikely, industry watcher Tristan Harrison said in a think piece on the Motley Fool Australia that there are triggers that could send prices hitting unexpected lows. I like how they use variable, specific words without having to make the investor nervous, you know? One factor is the stricter assessment of borrower expenses. Harrison said banks are being more conservative in how they use the household expenditure measure, the HEM, to assess the basic living expenses. This could result in borrowing capacity shrink by 10 to 20%. So HEM is like your debt service ratio, and adding your basic expenses in there. And sometimes when a lender is taking an application, okay, the problem is they don't add cell phone bill, car insurance, and rentals, contents insurance. They don't add nothing in there. So they think you have all this expendable income and you're paying $200 cell phone bill. You know what I'm saying? So this could result in the borrowing capacity to shrink by 10 to 20% if banks started factoring in higher living expenses. Exactly. That's what the banks need to do to properly know, because you do all this math and then what's the point when you can't even afford to eat? Oh, hopefully it doesn't ask me about my cell phone bill. It's like $200. This would kill the deal, right? It will kill the deal. $200 certain things will kill the deal. So they keep it on a down low. It's best to help the customer and to help the branch from having to deal with a default and having to have to start doing collections and stuff, to actually take the necessary information and underwrite the deal properly so that the lender and the underwriter and everybody at the branch, the institution, knows what they're doing. What would you lend your money out without knowing this information? I don't think so. Why is the bank doing it? Anyways, the Australian Prudential Regulation Authority, APRA, has sought to reduce the amount of loans that are lent to debt-to-income levels of more than 6 times. Harrison said nothing that the current Sydney housing market has an average of 9 times debt-to-income, Melbourne 8 times. Okay. So it says it right here. The Australian proper can buy in Sydney and Melbourne, because if the average debt-to-income level is no more than 6 times, okay, and nothing current, the Sydney housing market has an average of 9 times the debt income, and Melbourne 8 times. So people are out of reach of those areas. Why? They're moving west. Wagons west. Start colonizing your own country. I know it's desert. I know it's outback. I know you can make things work. Remember what Silicon Valley was? It was a complete dry, arid desert. You know what I mean? Dry, arid wasteland. It was a complete wasteland. You could back in the day, you could buy up land there for chump change in Silicon Valley. Anyways, in fact, a third of loans have actually been given out more than 6 times debt to income. As a result, Harrison argued that borrowers will not be able to buy homes above a certain price if banks adhere to this new ratio. This is just going to protect people, but then it's less houses will start selling. When less houses start selling and the middle class don't buy in, guess what? You got yourself an economic housing crisis. Access to finance will be stricter once new credit reporting applies. While banks rely on borrowers to disclose their debt, new rules compel them to get full debt profile of potential clients. Yeah. Why like internet bill, heating, electricity? We have to bring in 2 months bills of each one. Every 2 months electricity, 2 months hydro, 2 months gas, 2 months thing. So you see that the average is not like $300 and then $90 the other month. Two months internet bills. You know, that's how you do it, man. Then you take the average of the two. Anyways, meanwhile, interest-only borrowers face the risks of higher repayments as their loans turn into principal and interest. Nightmare. Remember these interest-only loans I talked about in Australia? Nightmare. And I think Australia, there's my cat. Australia and who was it? The UK. The UK was doing 110% loan to value. So they would give you 110% loan to value at signing. So they give you the value of the house, like to buy the house, and they give you an extra 10% on top of that to do any renovations or pay off any other debts. That just enslaves you, basically, what happens then. Lastly, foreign segments has been performing quite well as of lately. Foreign buyers in the past represented roughly 20% of new housing purchases. But with Chinese nationals finding it hard to get money out of China and regulators tightening investors' lending screws, demand has been dismal. With all these factors, Harrison stressed price falls are not hypothetical. He said, I don't think we'll see 20% fall in prices in 1 year, but the next 2 or 3 years could see numerous months where prices will fall in Sydney and Melbourne more than 0.5%. I wouldn't be surprised to see prices another 10% lower in 2 years compared to today. So, okay, a lot of people are looking at, 10% on a $1.4 million house, Mike. It's $140,000 less. That's not too bad. But these people don't own their homes free and clear. If you own your home free and clear and it goes down 10%, I own it free and clear. Who cares, right? I'm living in it. What do I care, right? Or I'm renting it out to somebody. I'm collecting. I don't care. But when you are on interest only, you still owe the $1.4 million bucks. So even a percentage, 2 percentage points, and with rates going up in November in Australia, they're kind of floating it around right now. They're floating around. Australia needs at least 4 or 5 more rate hikes to get things in check, especially with their dropping currency right now. I don't know if you saw it last week. They were losing to the American dollar right now, and it's dipping. You gotta fix things. You gotta get things rolling. You know what I'm saying? Anyways, guys, I wanted to throw this out there. Okay, if you own the house free and clear, it went down 10%. Who cares? It went up 40. What do I care? But when you bought it if you bought within the last 2 years, the wrong time, and you're paying interest only, you're smoked. You got to figure something out. You have to figure something out. A lot of these countries do not allow you. Let's see what this says. Don't mind the slump. Prices will rise again. The hopes of property buyers, homeowners, and investors have been in the slumps lately, as the market faces downtrend, with major markets reporting dismal performances over the recent months. However, industry watcher Aidan Devine said that these market players seem to have forgotten how the property cycle works. In a think piece in the Daily Telegraph, Devine said buyers often fixated on short-term events when in fact it was only last year when home prices were at their highest. They'd pay thousands more than they needed to thinking the prices offered will be a bargain in next year's time, he said. Yeah, well, people are throwing money at it and thinking, well, okay, even if I pay 40 or 30,000 over the asking, that's not too bad, because if it goes up what it did this year, I'm going to actually make an extra, let's say, 17 to 20% on top of my initial investment. Well, that's not the case, right? Devine noted that the current market trend, many would-be buyers are now unwilling to spend due to their assumption that prices might get cheaper in the next few months. The reality is that the market was never going to boom forever, but neither are we going to be stuck in a rut that stretches on indefinitely. I think it's, if you know what's going to bottom out, it's just like London right now. London's been in 18, 20 consecutive months in downtrending. Make no mistakes, prices will go up again at some point. Yeah, like in 30 years. Then there'll be another adjustment period of sluggish sales, followed by possibly another increase. That's how the market has performed for nearly a century. Don't count on that changing, he said. Well, you know that, and we've been talking about this for the longest time, that Australia's been in a bull market housing market since 1975. So if you look at it and follow the graphs and the trend, how it's been going since 1975, you'll see a couple of dips and blips, but they're not crashes. And while other countries went through many crashes, housing-wise, or condo crashes, or high-end luxury home crashes. You've seen it all in different sectors, you know. The trick, Devine said, was not to think too much about recent headlines about market declines. For instance, while Sydney's homes values have reported to have fallen 5.4% for the past year, prices are actually still 50% higher than they were 5 years ago. Okay, that's great if you bought 5 years ago, but what about the people that bought 4 and 3 and 2 and 1 year ago? They're not factoring that in here. If you're selling your home, you may not get the killer price your neighbor got last year, but considering how much you likely paid for the property, you'll still probably come out of your sale very well. A housing crash, this is most certainly not, he said. So, another one that's saying that there's no housing crash and there's no, you know, it's just a temporary fix. There's another one here. Price slumps expected to continue as mortgage restrictions start to bite. Okay, we know what this one's about. So I'll read it anyways, but we know what this one's about. Industry experts are expecting the price correction to drop home prices even lower as industry starts to feel the largest regulation of credit crunch. Citing study Endeavour Equity Strategy, the Australian Financial Review said the crackdown could slash loan values up 30% and would affect property prices. Our base case suggests expense ratios will increase sharply, serviceability ratios will decrease proportionately, and loan sizes and property prices will suffer in the order of 15 to 20 points in real terms. Meanwhile, lower house prices will reduce the ability for stressed borrowers to trade out for finance, the study says. Capital Economics chief economist Paul Dales shared a similar sentiment, predicting that there would be an additional price cuts in cities like Sydney and Melbourne, where home values are 5.4% and 3% their peak, respectively. Most worrying is that the prices will soon be falling at an even faster pace. The further decline in the number of home sales in March, the latest month of reliable data, to a 7-year low, was larger than the fall in the number of new listings, he told Business Insider Australia, suggesting that house prices in Australia capital cities will soon be falling 5% annually. In an analysis, macro business industry watcher Leith Van Olsen said that the market seems to be deteriorating at an increasing rate. Thank you. Somebody that actually knows what the hell's going on there. Aside from stricter lending standards and rising bank funding costs, current market conditions are also being influenced by the expire of the interest-only periods and planned reforms on negative gearing and capital gains tax. In 2007, 2008, down in the United States, when I was living in South Florida, a lot of people got bit with those interest-only and jumbo loans, and don't pay 0.5% for the first year, and a lot of people got bit in the butt right after, man. Ooh. Man, it was a huge downturn when those mortgages had to be renewed, and you had to walk into a bank and rates are up 3, 4, 5%. Ooh. These factors combined will continue to weigh on housing values and make investing in property a particularly risky proposition, especially in Sydney and Melbourne, where values are most overvalued. Investors are more dominant, and auction clearance rates, prices, and investor finance growth are already falling, he said. Australian home prices speed downwards. Australian home prices have recorded the steepest fall since 2011 after seeing a 0.6 month-over-month negative growth. According to CoreLogic, negative growth in July. Sorry, according to CoreLogic, the recent drop in dwelling values was due to the continued dry spell of seen primarily in Melbourne and Sydney. And guys, what happens with that is it brings out the benchmark medium home price across the board right down. Once those two big apples start going down and falling, the rest of the country medium home price starts to go down and makes it more attractive, you know, makes it more of an attractive price across the board, right? Across the board, though. Across capital cities, home prices fell by 2.4% over the year, with Melbourne outpacing Sydney's decline. Melbourne dwelling values were down 1.8% over the past 3 months, followed by Perth at 1.5% and Sydney at 1.1%. The starkest annual performance differential is in Melbourne, where the top quartile has seen values fall of 4.1% over the past 12 months, while property values across the lower quartile are 7.5% higher. CoreLogic head of research Tim Lawless told Business Insider Australia. Similarly, in Sydney, dwelling values are down 8% across most expensive quarter of the market, while most affordable quarter of the market has seen values fall by March, lower 1.8% over the past 12 months. For Lawless, the divergence between the top and lower end of the market shows tighter lending standards stumped by duty concessions are affecting the prices of more expensive properties. I read this article a few days back about Australia, about the more expensive housing is not moving. The focus on high debt-to-income ratios will intuitively impact the Sydney and Melbourne housing markets more than other cities due to demonstrably high dwelling prices relative to household incomes, Lawless said. He argued that the reversal of home prices in these cities is starting to affect the proper values, which had outperformed the national average in the past. Meanwhile, regional home prices also fell in July due to mainly to the lackluster performance of regional New South Wales, regional Queensland, and regional Western Australia, while 3 out of 7 rest of the state's regions saw fall in values over the 3-month period. The pace of growth across the remaining regional areas has clearly decelerated, contributing to overall softer results, he said. Looking ahead, Lawless noted that the strong supply pipeline might continue to put pressure on prices. So that's that, people. A little bit of Australian recap on what's going on in Australian housing crisis sector in my channel. Guys, I want to put a plug in here, guys. I got to plug my channel once in a while. I got some pretty good series here on my channel, guys. I invite you to please check out this. I got a few series here. There's trends in the housing market, housing crisis. There's my Rants and Lifestyle. If you guys get a chance, please watch my game store, Business from Scratch. It's a really good series where you kind of see the whole building of my business. And I'll leave a link below. And there's one called Starting a Home Business from Scratch. And I think it's like 54 videos of shipping and working from home and making this business that I have here at home very successful. Living the Dream series is how I left and moved to a small town and bought myself a gigantic house with many bedrooms and living rooms and all the space that I could wish for in living in the city. And then video game reviews and my son's channel. Anyways, let me know what you guys think in the comments below. Don't forget to check out my channel here and check out what I got going on. It means a lot to me when you guys subscribe and comment. And my page is basically, my channel is basically based off commentary and comments and what people have to contribute to the discussion. Thanks for watching and have a great day.